Thanks, everybody. Again, I want to welcome you to the Doug and Mike Show, also known as the HCM Fireside Chat. The first thing I want to do, considering how the world is sort of unfolding in front of our eyes, is recognize everybody who continues to go to work in high-risk areas so that our lives can go on pretty much as normal as possible. Healthcare workers, grocers, pharmacists, first responders. These are all special people that are taking over-the-top risks in order for us to pretty much carry on as normal. So we want to recognize them. As far as this call goes, like last week, we're going to hold the call to 30 minutes. We're going to have some updates that have occurred since last week's call financially, a little discussion of the markets and so forth, and then answer your questions. Don't forget, if you do have questions, the info box that is in the invitation is how you get them to us. And with that, let's get started. So the first thing I'd like to do is start with some good news. And remember that we want to be respectful of all the suffering and things that are going on, but this is a financially related topic, so we're going to just remember that that's our perspective. And the good news is that you simply can't drop $2 trillion into the economy and not have a meaningful portion of that ultimately find its way back into financial assets. We have a good model for that in the 2008-2009 financial crisis. And so from a long-term perspective, that money will ultimately, or a good portion of that money is going to funnel its way into stocks and so forth, and so that's a very good long-term indicator. The yin for that yang, or the bad news, is that may take a while, and that's because, at least in the short term, there seems to be some resistance to accepting all of the uncertainties around the business areas, the social areas, the economic and the market-related consequences of all the realities that we're seeing unfold in front of us. And because these things are likely to get worse before they get better, there's likely to be more fear and more emotional decision-making by investors. So as a result of all that, and Doug will get into this in more detail, but as a result of all that, we think that the valuation metrics could be lower for a while. This conclusion, we think, is reinforced by the fact that a lot of government assistance that's going to be going to companies is going to have strings attached to it that could complicate their capital structures, and so that's going to keep pressure on valuations for a while as well. And quite frankly, we're concerned that not all of this has been priced into the market yet. As a result of all that, we still continue to maintain our conservative posture in our advance and defend portfolios. Those are the portfolios that receive tactical adjustments. And of course, our strategic portfolios get regular rebalancings whenever the market volatility gives us an opportunity to do that. As far as the market activity goes, since last week's call, things have played out pretty much the way we discussed. There was a bit of a sugar high following the central bank announcement, the signing of the CARES Act, and then the big quarterly rebalancing. There was about $750 million that went into equities at the end of last week, the beginning of this week, just the very end of the quarter, in institutional funds, pension funds, endowments, things of that nature. But that process has now pretty much completed itself. So now we're kind of back to the reality of things. So that's sort of a snapshot of where we are just over the last week. What I wanted to do was touch on the two most popular questions that we're getting regarding the CARES Act that relate primarily to HCM clients. And then Doug will jump in and have some comments about the markets, and then we'll tackle the questions that have come in. So the two big things with regard to the CARES Act focus on the stimulus payments. Everybody's anxious to know if they're going to get a check, and if so, how much, and when it's going to arrive. And the other big planning opportunity that's presented itself is the suspension of required minimum distributions. So anyone who's receiving an RMD, you have income that's forced onto your tax return whether you want it or not, and that drives your tax liability up. It can make Medicare premiums more expensive. There are a lot of ways that can impact you. That's basically been taken away for this year, so that opens up a lot of planning options. So we're going to talk about those two things. First of all, with regard to the stimulus payments, unless somebody gets phased out, which I'll talk about in a minute, every person is going to receive a $1,200, or so let's say every taxpayer, most taxpayers will receive a $1,200 check. So a married couple would get two checks, so $2,400. If you have children living in your house that are under the age of 16, you get $500 for each of them. So those are basically the rules, but there are phase-outs. So if you make more than a certain amount of money, you'll lose 5% of the benefit as you go through the phase-out periods. So for example, single taxpayers, that would include married filing separately and qualifying widow or widowers. The phase-out begins at $75,000, and if your adjusted gross income gets to $99,000, you don't get any benefit. For taxpayers who are considered a head of household, that phase-out goes from $112,500, I believe, to $146,500. And married couples phase out between $150,000 and $198,000. So everybody gets a check. If you're considered a high-income taxpayer, which involves the phase-out, then you slowly lose that benefit. The thing that I want everybody to, and the way this is going to be measured is based on the tax return that you filed most recently. So if your 2019 tax return, if the service already has that, they will look at your AGI on that return to determine whether or not you qualify. And if you haven't filed that yet, if that return's on extension, because I think as everybody knows, April 15th has been pushed off now until the middle of the summer, they'll use your 2018 tax return. But in either case, they're going to refer to an AGI number on that return. But the reality is this benefit is a 2020 benefit. They're simply using those previous year's tax returns as a measure to sort of prime the pump and get these benefits out. Why that's important is that if you do not qualify for a benefit based off your 2018 or 2019 tax return, whichever one is referenced for the benefit, you may still qualify if your facts will get you under those phase-outs in 2020. The reason I point that out is that's a financial planning opportunity to manage income in order to get into a qualifying zone. Another thing to be aware of is that if you qualify based on the return that was filed and the facts turn out in 2020 that you did not qualify, so let's say, for example, you're a toilet paper salesman and you were just eking along the last couple of years, but this year you're going to make $1 million. You'll receive your stimulus check because your income qualified in previous years, but even though your income is above the phase-out in 2020, you do not have to give the money back. So that's sort of a windfall for people. So again, it's just something to look at from a planning perspective to see if there's an opportunity for planning there. In terms of how the money will come in, the fastest money is going to come via electronic deposits. So the Treasury intends to put put that money into the same accounts that you would receive your electronic refund, if in fact that's how you receive your refunds. If you receive Social Security, you'll have a direct deposit account. The money will go in there. If you don't have either of those electronic deposit accounts, then you'll receive a check by mail, and of course that's going to take longer. The electronic deposit should start in the next week or two, and the physical checks sometime by early to middle May. I think that covers that part of it. Obviously, if you've closed the bank account recently that received that, or if you've moved so that your last known address to the service isn't the one where you received mail now, that could create some complications that are going to have to be squared away. The other big thing that I wanted to touch on, and this is a big planning opportunity for people who are in this situation, if you're receiving required minimum distributions, and if you're getting them, you know what they are. Those are for people who have retired and reached 70 and a half or 72 under the new rules. They've been suspended. And so that creates a planning opportunity because the required distributions force you to recognize ordinary income on your tax return every year. And of course, that's going to drive up your AGI for purposes of these tests we've just talked about. But it also can put you in a higher tax bracket. It can make your Medicare premiums more expensive, and it can squeeze out the opportunity of doing Roth conversions, which is a great family wealth planning tool. So by not having the required distributions forced on you, there's a lot of flexibility in that area. And the one we're looking at most specifically, of course, are the Roth conversions, but that'll be something that'll be important to talk to your advisor about. So those were the two big things I wanted to touch on right off the bat. Now, Doug, it is your turn.
Okay, can you hear me, Mike?
Yes, I can.
Okay, great. Thanks. So the first thing I want to touch on before we get into the market-related stuff, I want to go ahead and acknowledge our operations staff, our trading staff, and our marketing staff. I'm sure that their job is much easier under normal circumstances when everybody's in the office and it's easy to kind of walk down the hall and ask somebody for something specifically. But they've all done a tremendous job adjusting to this new reality that we've had and have been outstanding at maintaining the level of service that we provide clients. So in no particular order here, Maureen, Kevin, Laura, Kimberly, Lauren, Di, Marianne, Kathy, Dan, and Matt, thank you very much. We certainly appreciate it, Mike, myself, and the advisors. So with that said, let's jump into market-related items here. So Mike touched on a little bit at the beginning of the call about what we've seen over the past week. So I don't want to rehash it too much. I just want to point out a few things. So based on everything that we'd seen, we were at a very, very oversold condition on the market. We certainly expected some kind of reflexive rally. Based on that, you had the pension rebalancing coming in. You had the stimulus announced. I don't know that anybody expected it to be over 20%, but at any rate, that's what it was. So to give you some context, though, about what that might mean, because I think the thing that's on everybody's mind right now is the bottom in, is this a new bull market? I think the Wall Street Journal actually came out and said, the bear market's over, we're in a new bull market, which looks a little silly after today, but nonetheless. So in the 2000-2002 bear market, there were actually 3 separate rallies of greater than 20% inside of that whole drawdown. And each one of them failed, and the lows were actually retested. Again, in the 2007-2009 bear market, there were 2 separate instances where you had a 20% rally inside the total bear market. So while it feels good to see green and to see, this kind of rally, I think it's really hard to say that we're not going to see additional volatility going forward. And I would say it's highly probable that we may not have seen the bottom yet. And the main reason for that, I think, and we've touched on this before, was the fact that we're now entering the phase where you're going to start to see economic numbers hit the tape. The first one that we got was the jobless claims last week. Now, if you read the Market Insight, we talked about this quite a bit just because it was such an odd day. But the jobless claims number came in at 3.3 million. The Wall Street consensus was for around 700,000, and the highest firm that I saw had at 2.5 million. So there was some conjecture about, was it priced in and whatnot. I don't want to get into the specifics of that. I'd recommend that you read our Market Insight. It touches on that a little bit more. But the point is, 3.3 million unemployment or initial jobless claims. That is a massive number. It's 5 times bigger than the largest one that we've seen since the data set started in 1967. There's another one that's coming out tomorrow morning that's expected to be higher. In the initial one, there was only 80,000 people from New York that claim, yet their Department of Labor has stated that they've received over 1 million phone calls by people trying to figure out how to do to claim unemployment. So that number should go up pretty significantly. And when you see those types of numbers start to come in, you're starting to grasp, the demand destruction and what this, the social distancing exercise is really all about. In addition, you had a Dallas manufacturing survey that was expected to be -10. It came in at -70. I had one of the advisors tell me that they had to pull up the chart to look at it, and they had to change the scale on the graph because -70 was so far below any of the numbers that they'd seen that it almost didn't fit. So I think as more of these economic data points start to come in, you're going to start to see a little bit more clarity around what fair value might be. And even at this point, I'm not quite sure that they've done, or that analysts have done a decent job of kind of projecting this. I mean, I was on a conference call last night with a very well-respected bond manager, and he had a list of 6 reputable Wall Street firms and their GDP forecasts for 2020. And amazingly, only one of them had a projection that was greater than -3%. And there was actually 2 firms that had a projection that was less than -1%. Now, to put some context around this, in 2008, we had back-to-back quarters of -7.5 and -4.5. And ironically, GDP growth never went negative in 2000. But if we're using 2008 as kind of a comparison here, to believe that we're only going to have -1% GDP growth with the economy basically shut down, it seemed, and in this manager's words, it seems almost impossible for that to happen at this point. Not saying it can't, but it's going to be very hard at this point to avoid something like that. So I think these reports, along with earnings that are coming out, is going to kind of allow this haze of uncertainty to clear a little bit and hopefully give us an idea of what fair value might look like. And then once we start to see that, we can then analyze, all right, what are the points or what are the sectors or what are the investments that we think provide the best opportunity, and what's the timeline on that? I think everybody wants it to be right away. Unfortunately, I don't think it's a process that's going to happen overnight. It's going to take some time. It's probably going to result in much more volatility than what we're seeing. But at some point, I know that we will get through this and we will come out the other end of this with a little bit of a stronger economy, so to speak. So when that time comes, though, we will be ready to aggressively re-risk portfolios, and we will make sure that everyone is aware of how and when we're going to go about doing that. So that's my remarks right now. So, Mike, if you want to get to the Q&A, we can get started.
Perfect. So we do have several questions. As I said, we'll do as many as we can, and if we run out of time, we'll reach out to you individually to address that. So the first one, so Doug, this is probably for you. It could be either of us, but you can take it. How confident do you feel with ETFs that we have now with respect to being positioned to come out of this slowdown?
So I'm fairly confident in the fact that ETFs will be a useful vehicle to gain or participate in any kind of rally that we would see. ETFs as a product have grown in popularity. They're extremely cheap. They're extremely liquid, and they track markets extremely well. The only other areas that I would think that maybe you could get some more bang for your buck is if you went with a highly concentrated ETF product or a highly concentrated mutual fund. But that also comes with some significant risks too. So I'm sure when the time comes, we will evaluate those. But if it comes tomorrow and we make no changes, I'm very confident that we will be able to participate using those products.
And I would add that going beyond this, so the ETFs are broader-based, diversified products. We've migrated to them almost entirely away from mutual funds because, as Doug pointed out, they're much less expensive, which obviously helps the overall portfolio. But also remember that we have three individual stock portfolios that we manage: a dividend growth portfolio, a socially responsible portfolio, and a growth portfolio. Those all have individual securities in them, which allow us to be more laser focused when we make security selection. So we think of them as working together. The ETFs allow us to pick up more market exposure in a hurry, broad-based, and the individual stocks obviously let us target in on very specific companies and qualities. Next question. With the severe drop in oil, do we foresee a majority of the energy companies cutting their dividends to preserve cash? And also, what does your crystal ball tell you about the bottom for the price of oil?
Well, I've seen reports, believe it or not, that have shown a prediction that oil will actually go negative. Now, you may hear that and say that's impossible. But it's in a scenario where producers would basically pay people to store the oil that they're producing. Now, I'm not insinuating that that's going to happen, but it goes out now. I think the most important thing to know about the energy sector is there's the kind of best of breed companies that are bigger in capitalization, more diversified in their business. Now, Grand Energy is still their main business, but they're diversified in the ways that they use it. There are extensions, some cuts, some recapitalizations, but we still feel okay owning those for the time being, where we do own them. I think it's in the smaller names, the E&P, the wildcat drillers, the deep oil drillers. Those are the areas still where I think that those investments are basically a lottery ticket right now. They have to continue to pump oil just to stay open. And by doing that, they're putting excess supply into the market. And as excess supply comes onto the market without demand to meet it, the price just continues to go lower and lower. So you saw two companies today in the energy space that declared Chapter 11 bankruptcy. I'm sure there's going to be more. So where oil is going to bottom, I'm not going to give a definite price, but what I will say is if you want to play in that space, just make sure you're owning the highest quality that you can.
Okay, here's one that came in. This is just going to take a second, but I do want to get to it. I'm going to ask part of it. Do you know anything about the website for 1099 filers? I'm an independent contractor, and under the new system, what are the rules? And also, regarding the benefits for paying rent, does that apply to my business? So the So independent contractors are entitled to unemployment. The website is, you could probably Google it, but if the person who asked has a pencil, it is unemployment.ohio.gov/. That's unemployment.ohio.gov/. And that's how you get there. If you have complications dealing with that, feel free to reach out to your advisor. We're more than willing to help you get through that. In terms of paying for office rent, yes, there are the stimulus loans that are forgivable if you meet the criteria, also cover rent. The bulk of them have to go for payroll and so forth, but some of that would also cover rent as well. We just have 1 or 2 minutes left. Our RMDs for inherited IRAs also suspended. We think the answer to that is yes. The statute does not, the Act does not specifically break out inherited IRAs. What the Act says is all required minimum distributions. The statute puts inherited IRAs and pretty much all retirement plan IRAs in different places because in one case you're the account owner, in the other case you're the beneficiary. That might be more information than you wanted. However, this is something we're still trying to get to the bottom of. As I read the statute, it's not clear. Commentators right now are not in agreement, but by far and away, clearly the Act says all required minimum distributions, so that's the opinion now, but we're going to get a firm answer on that. And it looks to me like we are out of time. So we'll handle the rest of the questions. I want to say thanks to everybody for tuning in, and also the offer we've made in the past. If you know somebody that needs some help with all this stuff, have them reach out to us. We'll be more than happy to help. There are no strings attached. This is a time when we all need to help each other. So again, thank you much for tuning in. If need be, and it appears it will, we'll see you next week, same time, same station. Thanks, everybody. Bye-bye.